Well, hi everyone. It's Russell here again from Enhanced Asset Management. Really hope this video finds you well. Just a bit of an update from us over here. Just post the quarterly we sent out a couple of weeks ago. And first off, we'd just like to start with performance for FY24. So our conservative portfolio produced a return of 7.31%, balanced 10.39%, growth 13.32%, and high growth 16.06%. Now, these are returns that are exceptional in our view, and we can say that because the AFR produced this nice little table over here, with the green bars showing for this little subset of funds here. There's about a median return about 9.19% for the average growth fund over FY24. Now, of course, this compares to our return of 13.32% for our growth portfolio. So it's an exceptional result. We're a step above well and truly above the median return. Now, I should note that this is just a little abbreviated version of the table produced. There's about 80 odd funds in here. So there's a long tail of funds that are well under this sort of level of performance. So again, we're very happy with the outcome for 2024. But of course, 2025 has already started, so we're off and running again. Now, one of the bigger drivers this year in terms of returns, and it has been for the last 2 years, is this little American flag up here represents this line here, this green line, which is the S&P 500. Now, it's been no secret that this level of performance has been attributed to the Magnificent Seven. So Apple, Microsoft, Meta, Alphabet, Amazon, Tesla, Nvidia. They're definitely responsible for the lion's share of returns, and we estimate around 80% of the S&P 500 returns have come from these 7 companies. So our strategy and our style of investing has meant that your top 10, which is shown here on the table on the left-hand side, constitutes about 37% of your portfolio, with the Mag 7, you can see here, being very well represented. Now, of course, they're very good businesses, and the share prices are also very good. They've run very hard. We're a little bit worried about performance, and we'll come back to that in just a moment. So another driver of the returns this year have been positioning within Australian equities. And again, we've put a little Australian flag here this time, with the blue line here showing that the Australian market was a bit of a laggard. Now, in our mind, this shouldn't come as much as a surprise. We've been heavily tied to China's fortunes recently, and with their downturn in the infrastructure and property markets, the Australian market was a laggard in terms of asset class performance in FY24. Now, to circumvent this somewhat, you would have noticed that we've been a lot more active with our direct investing in our share picks. And what this little table over here on the left shows some of the performance in purple of our holdings versus the benchmark returns over a similar period. So, for example, Life360, 32% return versus around 1% over the ASX 200 since we've held 360. So that our direct share positions have really been a huge driver of our performance over the ASX this year, and we will consider a lot more companies as the reporting season progresses over the course of the next 2 or 3 weeks. So far, we've had ResMed, Life360, and AGL report in terms of our current holdings. All have reported exceptionally well and very strong. So we're very happy with the way reporting season is going so far. Just going back to that valuation issue that we noted just before, you can see here on the left-hand side, large cap performance within the S&P 500 has really been the standout with 28, 29% returns over a lot of the styles. Now, this compares to the small cap performance, which 3 to sort of 10%, average of 4 to 5%. And whenever we see the differential of this magnitude, and that's in the order of plus 20%, returns versus growth 25%, small caps 5%, that 20% differential, whenever we see that, what typically happens according to our research is over the next sort of 18 to 24 months is we get a bit of a catch up in terms of valuation growth for small cap shares. So what we're doing at the moment is we're repositioning some of your large cap exposure into small cap exposure, and you'll see that flowing through into your portfolios. We're about 50 or 60% of the way there, and we'll aim to have that completed by the end of September. Just in terms of your fixed interest or bond exposure, arguably, we've been through a bit of a tough patch with fixed interest, with inflation and interest rates. But at the moment, fixed interest is looking the best it ever has since the portfolios are incepted. Running yields are around 4 to 5%, and with Europe looking at cutting rates or having cut rates, there's a high chance that the US will cut rates in September. Australia looks to have stabilised here. There's a fair bit of jawboning either way from politicians or the RBA, depending on who you listen to. It looks very stable here at the moment with inflation coming down. So this is a very good environment for fixed interest, with the potential with interest rate cuts or stable interest rates that will see some value or asset growth within those fixed interests as well. So bonds looking very good. Now, just the last few weeks, we've seen the S&P correct about 10%, arguably owing to the strength in equities that we've seen recently. 15% for the Nasdaq, the Nikkei 25% when the central bank there lifted interest rates, and 6% for the ASX, because the ASX 200 really hasn't had the run that international markets has had. So in April, there was a little bit of a pullback in US markets, and we noted at the time, barring a growth scare with a large increase in unemployment, we just considered the pullback to be healthy. And currently, we have a similar view. We're not seeing any big macro headwinds that could see the market fall significantly further. So if this continues, if the market correction continues, it will lead to it'll be an advantage for us, because it will lead to additional purchases for your portfolio. Now, this could come at a pretty good time, because we're pleased to announce that we've been working over the last sort of 4 to 5 months on a high conviction portfolio. We've been building the strategy out. We've been getting it approved by our trustee and by our licensee. Pleased to announce that has been approved, and it's currently being set up on Mason Stevens at the moment. So this portfolio is going to be a very actively managed, high convicted positions, around 10 to 20 positions, with the ability to be able to have 30% in cash, should we see some headwinds develop for markets in terms of corporate earnings, and them likely to be depressed over the foreseeable future. So it's going to be a lot more dynamic. It's going to be a lot more trading. It's going to be very different to the core of your portfolios. So it's going to be one of those investment funds where we see opportunity, we're going to go a little bit harder and be a little bit more aggressive. So very excited about that product. We have a history of being able to perform very well using similar strategies in the past. So we're very excited to launch that, and we'll provide more updates on that as time progresses. So that's all for me today. As always, this is just general advice. Again, hope this video finds you well, and I look forward to catching up with you soon. Thank you.